Hello all, welcome to this new Energy Scan webinar session. We are going to wait 1 minute to let more people coming in. So, welcome to those who just joined. It's now time to launch this mid-year webinar session. I'm Julien Waro. I'm in charge of the economic research team here in Paris at NG Global Energy Management and Sales. Today we'll spend 90 minutes covering the whole energy landscape from macroeconomics to oil and gas, as well as European carbon and power markets, and we'll see if geopolitics will continue to trump fundamentals in the coming months, as it has been the case for most of the first half of 2025. So today, the whole economic research team will be speaking. Olivier Gasnier for macroeconomic and crude oil, Évariste Nouki for natural gas, Paul Chavy for carbon markets, and Luc Ruffier for European power. So let me remind you that this is an interactive session. So as usual, don't hesitate to ask questions using the chat module. So check out the buttons on the bottom right corner to ask questions directly or chat with participants. We'll do a Q&A session at the end of each part of this presentation. And I remind you that the session will last 1 hour and a half. You will also be asked to fill a one question satisfaction survey at the end of the session. You can already download the slides of this presentation by following the steps displayed in this slide. So just click on apps on the bottom right corner, then handouts, and you should be able to download the PDF presentation. And the replay of the session will be available on the EnergyCan platform by tomorrow at the latest. So it's now time to move on to the first part of this session with Olivier on macroeconomics and crude oil. And as usual, we will start with a one question poll to launch this part of the presentation. So let's go. Of course, the main macroeconomic topics of the past few months has been the trade war launched by Donald Trump. So considering the ongoing US-EU trade tensions and the 1st of August deadline for new US tariff, what do you believe is the most likely outcome for US import tariff rates on European goods in the near future, probably by the end of the year? Is it 0%, so meaning that tariffs are fully removed and a deal has been reached? Is it 10%, which is the current situation as we speak during the negotiations? Is it 30% tariff rate, which has been announced and could be implemented, or is it more than 30%, meaning that we have a further escalation in tariff? So we see a large majority of you thinking about 10%, so the current situation, so no move during these negotiations. Still 20% thinking about 30% rate, which should be a sharp hike in the tariff rate with probably significant consequences. So Olivier, I think this is of course a topic you will handle in this presentation, but the stage is here.
Yes, thank you, Julien. Hello, everybody. Thank you for joining us today. Indeed, we'll start by trade war. That was already the case 3 months ago, if you remember. That was just after the shock of the Liberation Day, the announcement by Donald Trump of reciprocal tariffs. So many things have been happening since this day, but all in all, we can say that the outcome of this trade war is still very uncertain. You know that the deadline for negotiations that was on the 9th of July has been postponed to the 1st of August. So for most of the countries, the negotiations continue. There have been two deals with countries, with commercial partners of the US, Vietnam on the one hand, and Indonesia on the other hand, that has been announced yesterday. I don't consider that the deal that was reached with China to lower the exuberant tariffs implemented after escalation until the 12th of May can be considered as a real trade deal. The negotiations are actually continuing. On this table, you can see some examples of the evolution of tariffs between the announcement on the 2nd of April, reciprocal tariffs, and what could be the outcome after the 1st of August if there is no deal precisely for various countries. I mean, it's not an exhaustive list, but you can see that it's difficult to find any logic between those cases. In general, we can see that the absurd customs tariffs applied to small countries would be significantly reduced. That's one good thing. You can also see that, for example, for the yes, I didn't mention that, of course. There was also a deal with the UK. That was the first country to announce a deal. But you can see that the minimum tariffs remains at 10%. So we can consider that anyway, even if there is a deal, the tariffs will remain probably at a minimum of 10%. There is probably almost no chance to see tariffs coming back to zero. For Canada and Mexico, they have a trade agreement, but nevertheless, for part of their trade, Trump has threatened to impose tariffs as high as 35 or 30%. And you can also probably see this big 40% for Brazil that is linked to political consideration, as Trump considers that the former President Bolsonaro is not rightly pursued for having fomented a coup d'etat after he lost the elections. So various situations, difficult to know exactly what will be the outcome, and you can see that for EU, for example, for the time being, if there is no deal, the tariffs would climb to 30%. What is interesting is that on the markets, the situation is almost considered as over or solved. I mean, there was a real shock on the Liberation Day, the announcement of reciprocal tariffs. And since then, we have seen really a sharp recovery in the main stock market indices, from records to records, especially in the US. Now we are at record high levels. So it was very interesting to see that despite the announcement made by Mr. Trump over the last few days, since he has postponed the deadline for negotiations, there has been almost no negative market reaction, except for some sectors or countries, especially I think such as Brazil. But you can say that, generally speaking, the markets no longer believe Donald Trump, and they consider that at the end of the day, there will be a kind of happy end to a trade war with limited increase in tariffs, or deal with almost nothing, but no increase in tariffs after that. So that's interesting, because what we had seen first in April and then also in May with China is that if Donald Trump changed his stance and gave more time to negotiations, that was under the pressure of markets. This time, there is no pressure coming from markets. So you can also maybe imagine that in this context, he feels really encouraged by this absence of a reaction from markets and continue and impose effectively higher tariffs after the 1st of August. There is still a risk. So in terms of economic impact, this is about the same. I mean, we feared 3 months ago that there would be really big consequences on activity, on investments, etc. And finally, we have seen ups and downs on activity. For example, the US trade deficit widened sharply in Q1, triggering a slight contraction in GDP, but there will be a rebound in Q2, probably by more than 2%. Otherwise, very few economic consequences. For example, for China, we had seen really a big decline in exports towards the US, but after the decline in tariffs, the June figures show a rebound, for example. If you look at the PMIs, so the purchasing manager indices, which are the main indicators, you can see no trend or even a slight positive trend over the last few months. As far as consumer confidence is concerned, there were a sharp rise in fears of inflation at the start, especially in the US, but that has been partly corrected already. So for the time being, it's quite difficult to find any evidence of this impact of the trade war on activity. So in terms of economic forecast, at the beginning, everybody started to lower sharply the economic forecast, especially for the US, as the negative consequences were expected to be big. And since then, we have seen a steady and slight upward adjustment in those forecasts. And now we have, for example, for the US forecast that is around plus 1.5% for GDP growth this year or next year. For next year, of course, there is a big deal of uncertainty remaining, but for this year, we are almost certain that growth overall will be hardly lower than its level of 24. We expect global GDP growth to be around 3%. Last year it was 3.3%, so it is clearly not the big crisis that was expected. For China, China is still on course to have a GDP growth of close to 5%, which is the official target this year. Nevertheless, the last figures show still no recovery in domestic demand. Still, the crisis in the housing sector, so they still rely on exports. And of course, the outcome of the trade war with the US is very important for China. For the euro area, there has been a kind of wave of optimism following the announcement made by Germany about its budgetary policy. So relaxation, the increase also in defense spending that has been agreed among other European countries. But you can see, I mean, with the example of France yesterday, that there is no room for maneuver in terms of relaxation of fiscal discipline, except for Germany. And so for most of the European countries, it would be extremely difficult to implement very active, very supportive policy for the coming years. As far as inflation is concerned, still the same, more or less the same conclusion. I mean, so far, disinflation has continued. So we had yesterday more worrying US numbers with a slight rise in core inflation to 2.9% year on year, and also a rise in the inflation rate. So that may be the first consequences of the trade war on the rise in tariffs and the level of prices in the US. But all in all, it's for the time being, it's very very moderate. What we can see is that there was a sharp increase in inventories before the rise in tariffs, so that has allowed to defer the impact of those tariffs. And if you have no big changes in tariffs, the level of tariffs after the 1st of August, this impact will remain moderate. Once again, I'm not sure it will be the case at all. I mean, for some countries, there could be a significant increase. But so far, the impact on inflation has been rather moderate. For the US, it's still uncertain because you have, of course, this is where you could have the biggest consequences due to the sharp rise in the cost of imports if the tariffs are increased again. This has some consequences in terms of monetary policy. The ECB has been able to lower rates, key rates, multiple times. Now they will very likely mark a pause in July. And after that, everybody agreed on the fact that probably the room for maneuver now for the ECB to lower rates is really limited. It will also depend on the orientation of fiscal policy, the outcome of trade war, etc. For the Fed has stopped lowering rates at the end of last year and has been unable to lower rates again due to uncertainty precisely on the impact of trade war on inflation. There is really a big pressure put by Mr. Trump and the people of the White House on the Fed, and especially on Jerome Powell, the president of the Fed, who should leave the Fed at the end of this mandate next May 26th. Until that, probably the White House will continue to put a lot of pressure on the Fed to lower rates. But as I told you yesterday, we had some inflation data that were not completely reassuring. So the probability of a Fed rate cut at the end of this month is almost zero. And now the market only expects a probability hardly above 50% for a cut in September. On the market expectations are that the Fed could cut rates by 1 time, 2 times maybe by the end of this year, but it's not a guarantee. And we should also consider the political factor because there could be some probably big volatility created by the political environment next year with the prospect of midterm election at the end of the year. So all this has to be taken into consideration. And for the time being, the Fed is not in a secure position, I would say, to continue lower rates. One word maybe about the Bank of Japan. The Bank of Japan has started to normalize its policy. They have more or less stopped to do so. Why? Because the consequences of this increase in short-term rates has been a gradual adjustment of long-term interest rates. And by the way, it's interesting to see that now the long-term rates for the 10-year, for example, in China and Japan are very close. And probably that reflects the opposite trends between China and where there is deflation, and Japan which exits deflation. And so we could see probably in the next few weeks the Japan rates being above Chinese rates, which was completely unthinkable until last year, say. So there could be some consequences of that, given the fact that the yen carry trade has been for many years a successful strategy for investors to borrow money in Japan and to put this money in countries with higher rates. If this carry trade begins to be unwound. Actually, I mean, there could be some repatriation of capitals from the US market, for example, or European markets to Japan, that could really put under pressure bond markets in the US especially, and also in Europe, with a rise in interest rates as prices on rates are inverted, correlated. So the BOJ stopped normalizing its policy because there was increasing tensions on US markets in particular with rising interest rates. This is something to have in mind because the normalization of the Japanese policy can have big consequences on global bond markets and could trigger quite a significant increase in the level of bond yields in the US, but also probably in Europe. One word on the FX market, just to underline the fact that you can see this sharp divergence since the announcement of reciprocal tariffs at the start of April between the evolution of the spread, the interest rates spread between the Germany and the US on the 2-year maturity, but you can exactly see the same conclusion for the 10-year rates, for example, and the evolution of the euro dollar. That means that the US dollar should have benefited from the fact that the ECB cut rates aggressively while the Fed was unable to do so, and also the fact that normally the implementation of tariffs should have supported the US dollar, and that was absolutely not the case. Normally also the dollar is a safe haven, so when there is an increase in the level of risk, that tends to benefit to the US dollar. That was not the case this time. That reflects a kind of aversion of investors with US assets, a kind of loss of confidence of foreign investors in US assets. And this remains really the case. I mean, we have seen a slight upward correction in the US dollar over the last few days, but it's very, very limited compared to the to this spread that has not ceased to widen between the rate spreads and the evolution of the exchange rate. And this is about the same for the pound. Why I mentioned the pound? Because it's important. Because the pound looks structurally weaker since the, if you remember 22, when when Liz Truss, the Prime Minister of the UK, decided to open the tap for public spending, and there was a clear immediate sanctions of the bond market. And since then, in a way, market have lost confidence in UK policy. Each time there is a problem in terms of fiscal policy in the UK, where, I mean, there are doubts about the willingness, for example, of the government to control spending. Like that. You have an immediate weakening of the pound. So that means the market has, keeps in mind those kinds of events for a very long time. And this is why it's difficult to imagine that the US dollar will recover sharply. I mean, clearly, investors are really reluctant to invest more, given the kind of unpredictability of the Fed's policy, of the Trump's policy since the start of his second mandate. I wanted also to say a word about of course, the oil market. So if we just focus on the last 2 months, say, we have seen mainly a peak at the start of the month, end of June and start of the month, on the level of oil prices due to the sharp tensions in the Middle East, the war between Israel and Iran, the US attacks against Iranian nuclear sites, And then all this ended with the ceasefire between Israel and Iran. We have seen prices increasing to almost $80 per barrel for the Brent, and coming back almost to where they were previously. That is to say, between 65 and $70 per barrel. The situation remains tense because there are some attacks of the allies of Iran in Yemen, the Houthis. They continue to target some cargoes in the Red Sea, so that continue to disrupt the maritime trade through the Suez Canal, for example. But all in all, the geopolitical risk premium has diminished considerably. Now the market is more focused to fundamentals. And the fundamentals are that the prospects for demand are quite uncertain due to trade war, and that supply is on a rising trend. Why? Especially because the OPEC plus group has completely changed its strategy and has decided to increase sharply its output. For years, they have tried to reduce output to try to support prices, and they have decided first to cancel the output cuts that were applied last year. And they had planned to do so in 18 months until September 26. Actually, they will have done that probably at the end of September, if they do in September what they have done in August, that is to say, to increase their output quota by more than 500 barrels per day. 500K barrels per day, sorry. So that's a complete change of strategy. And now the question is, what will do Saudi Arabia in particular? Because, of course, this kind of decision is mainly taken under the pressure of Saudi Arabia. Saudi Arabia was producing close to 9 million barrels per day. At the end of the year, they will be close to 10 million. And now we can clearly envisage maybe that this recovery will continue, and that they could produce close to 11 barrels per day in 26. All in all, I mean, in 6 months, they will have put on the market more than 2 million barrels per day, despite the fact that this process of increasing output is partly offset by the fact that some countries of OPEC try to offset the fact that they have produced more than their quotas during 24. But nevertheless, this is a significant move that contributes to increase the supply on the market. And that creates a situation where you have an imbalanced market, which is clearly oversupplied, with the evolution of supply, of global supply, being stronger, being bigger than the rise in demand. If you look at the recent evolution in prices, I would tend to say that probably this is linked to the evolution of the trade war. You have seen the lack of reaction of markets in general to the threats of Mr. Trump. I think that reflects optimism. And probably this is what we observe also on the oil market. The fact that probably the market say, well, maybe the demand prospects are we are too pessimistic, we need to adjust them, etc. Well, if you look at the latest International Energy Agency report that has been released yesterday, they have again cut their demand prospects. So I think this is a bit of over-optimism of the market. On the supply side, once again, I think that you have still the risk that Saudi Arabia wants to pursue its new strategy to regain market share, and wants to put more oil on the market, and they could do that until effectively there is a sharp fall in oil prices. So I see clearly risks on the downside, and I wouldn't be surprised to see prices correcting to the downside from their current levels that remain rather close to $70 per barrel for the Brent. I think that's it, Julien.
Thank you, Olivier. Yeah, two questions for you. In the chat, even if a deal is reached regarding the trade war, given what President Trump has shown regarding Europe in general, would the impact of such a deal be positive for the European economy?
Well, this is quite a large question. I think, already finally you have a kind of a deal that has been reached for the defense sector. The fact that at the latest NATO summit, the EU countries promised to increase their defense spending to 5% of GDP. Actually, it's 3.5% strictly speaking for defense spending, and also 1.5% for expenditure that are linked to those spending in terms of services, infrastructure, etc. So we know that in the short term, the European countries don't have the capacity to produce more arms, or enough arms to meet those targets. So that would mean probably more imports from the US. This is the first point. After that, you have many questions about the car sector and also the agri-food sector, because this is one of the main targets of Mr. Trump. He wants the US to export more agricultural products coming from the US to Europe, but it's impossible due to sanitary rules, etc. So it's a very complicated topic. I don't think that of course the negotiations will be over at the end of July. We could envisage that the negotiations period is postponed once again, but with tariffs remaining at 10% for the time being.
Okay,
After
thank you.
that, knowing if it's good or bad, complicated.
Okay, thanks for this answer. We have several questions about the OPEC Plus strategy. Notably, I think you mentioned that okay, we are back to fundamentals after this geopolitical really busy period. Regarding OPEC Plus decision and also the data, is their strategy still linked to geopolitics finally, and not only to supply-demand balance?
It's a very, very complicated question because in parallel to the war with Iran, Saudi Arabia has tried to be a bit closer to Iran to normalize the relation. They also, you have seen the visit of Mr. Trump in Saudi Arabia. I think that was in May or June, I don't remember exactly. But with many contracts, so a rise in Saudi Arabian imports from the US, so closer relation with the US. But also you have the OPEC Plus group, which includes Russia. So it's a very, very complicated game between all that. Saudi Arabia tries to have a central role in the Middle East, try to keep connections with Iran, Russia, the US. So it's very, very difficult. And inside OPEC, from an economic point of view, they have decided to regain market share. They were fed up with the fact that Iraq and Kazakhstan, for example, were producing systematically above their quotas, and they have completely changed their strategy. They are clearly the idea behind that is to say we have the lowest cost of production. We can afford, maybe not for a very long time, but we can afford prices much lower than their current level. And on top of that, that would probably seriously weaken the US shale oil industry. So this is why I think there is nevertheless quite a strong incentive for the Saudi Arabia to continue producing more and to push a bit the limit until the real collapse in oil prices.
All right. Thanks a lot, Olivier, for your presentation and your answers. It's now time to switch to the second part of the presentation with Évariste on the natural gas market and LNG market as well. Hello, Évariste. So I will launch the gas poll, and after the trade war, now we are back to pure market fundamentals with your guess on TTF spot prices. So they average 41 euros per megawatt hour in the first half of the year, 34 euros last year, and 40 euros in 2023. So what will be their average level this year? Is it between 20 and 30 euros, between 30 and 40 euros, between 40 and 50, or between 50 and 60 euros per megawatt hour? So we see, very large majority of you thinking about an average between 30 and 40 euros per megawatt hour, so something close to what we had last year, even if the first half of the year has been above this level. So you probably anticipate much lower prices in the second half of the year. So Évariste, we'll see if it fits with your view.
Thank you, Julien. So let's see. We'll start with the fundamentals, of course. We talk about the fundamentals, so let's start with them. This is the usual supply-demand balance for the European Union plus UK. Just to say that in June, demand was down. On the comments on the right, you can see the split. Demand was down for local distribution zone, which is mainly residential commercial. Down as well for industry, which tend to offset higher demand coming from power generation. Now, if you look at the values for half year, the first half year, we were up on residential commercial, we were down on industry, and we were also very strongly up for power generation. But overall, what we can keep on this table is clearly that the situation has improved compared to the previous months, with a narrowing of the storage deficit. You can see it on the last row of the table. So the situation is improving, mainly thanks to LNG. That's why for the European gas balance, it's more and more important to monitor what is happening on the LNG side. Good news from the US, you can see that US LNG supply is increasing very strongly thanks to some new liquefaction capacity, and this is helping total supply, which is on the right, to increase. In particular because some plants which were in maintenance in Malaysia, for instance, have resumed production. So you see now the upturn in the total LNG supply. So the good news are the start of some LNG liquefaction plant. I put here LNG Canada, which started in June, late June. On Plaquemine, which started last year, December of last year, the good news is that probably the plant could reach its plateau phase earlier than expected. I put here the numbers we had from last Sunday, and you see the strong increase in the feed gas volumes for Plaquemine. So good news on the supply side, which is helping Europe to have more LNG. So on the graph on the right, you see Europe LNG import increasing from June thanks to this higher supply. But you see thereafter a slowdown. On the left, you see flows going to Asia. They are rather stable, so it's not really Asia that is taking more. That's why you have to monitor more and more what is happening outside Asia, because we tend to focus on competition between Europe and Asia. But you have to know that some other countries are joining the party, particularly to take some US LNG. So here you have the netbacks from one of the biggest US LNG export terminal, which is Sabine Pass. So along with the usual netback we show from Asia, Japan, and China, for instance, I put here some numbers from all the new buyers of US LNG. These are buyers from Latin America. You have Brazil, Argentina, Mexico. And you see that from time to time, the netbacks are higher for those countries. Of course, they are benefiting from low shipping costs. They are closer to the US, but also you see that they are ready to pay the price. And some of them are paying the price, in particular for Argentina, when domestic production is falling. In Brazil, you can mention the hydro situation. So it is currently comfortable. This is helping the netbacks to drop. But this is just to tell you that more and more European buyers, they have to compete with Asia, but also they have to care about competition coming from those countries. Here you have the numbers for the month of June for US. You see that the majority of US volumes went to Europe, of course, although they slow compared to May. We had 66% in June compared to 68 in May. And second, Asia take almost all the remaining volumes, but you see that some volumes went to Latin America. And some others went to Egypt as well. Egypt, as a reminder, used to be an LNG exporter, but now because of falling domestic production and rising summer demand for cooling, for power generation, Egypt is now taking more and more LNG on the global market. And Egypt is ready to pay the price. From time to time, they are ready to pay above the TTF price to make sure that they can have the volumes. So this competition is more and more relevant for Asia. And this is also preventing European prices from falling too much, because those countries tend to pull prices on the upside. Hopefully, LNG supply is expected to increase. When you look at the split, we already talk about the US Black Mine, we talk about LNG Canada. The next are clearly the next biggest. You have Golden Pass in the US. You have as well the North Field expansion in Qatar. So strong increase in LNG supply. But the question we have to ask is to know if this increase will lead to oversupply. Not so sure. Maybe, maybe not. Why? Because don't forget that in order to avoid high US tariffs, a lot of Asian buyers, of course, except China, you take South Korea, Japan, India, the main LNG importers, they are all considering buying more US LNG to avoid high tariffs. And they have the capacity to do so, because you know that regasification capacity is far above liquefaction capacity. So the constraint is not really on the regasification, it is on the supply side. So they have spare regasification capacity to increase their LNG imports. So they could try to increase US LNG import just to avoid high tariffs. And second, you have more and more newcomers in the LNG market, so new buyers of LNG. So this means that yes, liquefaction capacity, total supply will increase, but at the same time, you could also see an increase in LNG demand. And if this happens, it means that probably the oversupply we expected will not happen with the same magnitude. Let's now move to prices, starting with the one on the right. You have a global overview of energy prices, and you see that in the second half of June, with the easing of tensions in the Middle East, gas prices dropped strongly in parallel with oil prices. So this is the important point here, the strong correlation between European gas prices, let's say TTF, and Brent prices. Strong correlation, meaning that now it is much more difficult for prices to break below this support. This support is relevant. I'll come back to it later on, but you see as well on the graph on the left that prices found also some support from technical buying. Behind technical buying, you can imagine some investors that also know the correlation with Brent prices. So those two elements to me explain the rebound we saw in prices after the collapse related to the easing of tension in the Middle East. So why are oil prices so relevant for the gas market? Yes, we are in a world of energy transition, but you must not forget that oil is still the dominant energy source. Around 33% of global energy is oil, which is used, in fact. So this is quite strong. It depends on the geographies, but in some geographies, that's why I put here the new buyers of LNG, being Egypt, countries in the Middle East, countries in Latin America. For those countries, very often gas is in competition with oil prices. That's why oil is relevant for them. And on top of that, oil is of course relevant for the mature buyers of LNG because of the oil indexation in long-term contracts. So the market seems to have found an equilibrium around the Brent price. So the question is, how long will this equilibrium last? Before moving to try to answer that question, we can start with the overview of the gas stock scenarios. You are familiar as well with this one. Let's just focus on the comments on the last paragraph. You have a lot of uncertainty currently on the gas market. You have the trade war, you have the tension in the Middle East. Also, the risk premium linked to those tensions has declined. You cannot totally rule out a revival in the coming months. You have as well the impact of the hurricane in the United States. So far, no impact. So they have been the infrastructure has been spared from hurricane, but the season is not over yet. It's lasts until end of November. So many uncertainties, meaning uncertainty on the final level of European gas stocks at the end of the year, or even at the start of the heating season. But what is sure is what we saw about LNG. Strong increase in LNG supply, meaning that probably we are on the LNG scenarios on the upper part of the table. So this is the good news. Of course, to have this good news, Europe is paying the price, paying higher than the others. But this means that at the end, probably gas stocks in Europe could be between scenario 2 and scenario 3. So we are not in the worst case for sure, but we are not yet confident enough to say that we'll be in scenario 3. So this we can translate it into prices again. We already showed the correlation with Brent on the spot on the month side. Here you have the oil curve. In fact, since mid August of last year, TTF, and you can also add GKM prices, they tend to trade above Brent prices. As I say, this is the condition, at least it appears to be the condition for the market, for Europe to continue to benefit from strong LNG supply. Meaning that remaining above Brent prices, you are triggering substitution towards oil, destroying gas demand in the countries where this can be done. So leaving some gas LNG flows for the European market. So condition to have strong LNG supply remain above Brent prices. Now the question is, for how long will this last? For a long time, it was believed, and personally that was also my belief, that thanks to the strong increase in LNG liquefaction capacity and LNG supply, TTF and GKM prices were expected to drop significantly below Brent prices. But now, when you look at the forward curve, it seems that the market is not totally confident about this outlook. Of course, this could happen, but when you look at closely the graph, you see that the market expected to not to happen before 2027, and perhaps not with the high magnitude we expected. And again, when you look at the graph, you see that clearly the market seems to be in an equilibrium set by the US LNG long-term marginal cost. In a market with strong competition, you should have expect prices to drop to the short-term marginal cost, which is much lower, probably in around 20. Now you see the market is closer to the 30 level. So to me, this is an important point. In fact, also linked to the new world Donald Trump has triggered, pushing some orders to buy more US products, mean that if the market is now mainly driven by long-term buying, long-term purchases of US LNG, you tend to set a benchmark which would be closer to the long-run marginal cost, so difficult for prices to drop, at least when you are on a forward basis. Of course, on a spot basis, you could drop to the short run, but on a forward basis, it seems that the market find it difficult to drop below the US long-run marginal cost. And then this is also related to the question Julien asked you at the beginning. Will prices be between 30 and 40? Yes, I think so. Knowing that 30, you are below the Brent price. Olivier said that he's a little bit bearish. So if Brent prices drop, and if they drop down to 60, if you translate that value in euro per megawatt hour for the gas market, it should be around 30. So to me, it will be difficult to drop below 30 because 30 is the level of the Brent, and then on the upside, difficult as well to rise to gas oil prices, for instance, because if this happens, some countries, particularly in Asia, China in particular, they will not accept to buy at such high prices. So I agree with the audience to say that, yes, I believe that prices should remain in this range between 30 and 40. That's all for me, Julien. I don't know if you have some questions.
Yeah, thank you, Evariste. We have some questions for you, notably regarding Henry Hub prices. So you showed the expected steep increase in the US LNG export capacity in the coming months and years, which is good news for Europe. But is this additional export capacity will require more US gas production to supply all those export terminals? And is there a risk of an increase in the Henry Hub prices at some point?
This is a very good question. I will not say it's a risk for LNG, and your prices are already increasing. So the risk is already materializing. And some US buyers are already complaining about the rise in Henry Hub prices due to higher LNG export. This is a very important issue for the European market, because of course, in Europe, we focus on the liquefaction capacity. Liquefaction capacity is important, but then you need to have the feed gas. And this feed gas is in competition with US domestic needs. In US, you have an increase, a structural increase in gas for power generation, particularly during the summer. So during the summer, you can have competition between, okay, I want to export to Europe, but at the same time, I have some other internal needs to supply. It could be for artificial intelligence, for instance. So yes, this is a real risk for Europe.
second question linked to this sharp increase in US LNG export capacity. It may increase also European vulnerability to American political decisions on natural gas. Do you think it will be the case or something similar to what we observed with Russian gas in 2022?
Yes, there is a risk, but the good news is that in the US, these projects, they are private, so they want to earn money. So if European buyers are paying the price, they will have an incentive to send the LNG to Europe. Yes, you can have some internal pressure to keep the LNG there, but to me, the risk is not so high because these are private projects.
And one last question regarding European gas supply. What is your opinion on the likelihood of an agreement at the European level to phase out Russian gas and LNG for good?
There is already an agreement, so Europe is clear about the position. Some countries are still opposing this decision. Recently, there was some comment from Slovakia. Of course, all the countries that were highly dependent on US LNG, so they are trying. But the answer from European authorities is to say, okay, the decision is taken, so we want to phase out Russian gas, but you have as well to take into account the position of some other countries and try to find measures to alleviate the burden for Hungary or Slovakia. But for Europe, the decision is clear.
Okay, thank you, Evariste, for the
Thank
presentation and your answers. So it's time to move on to the carbon part of this webinar session with Paul. Hello, Paul.
Hello, everyone.
So as usual, a small poll regarding EUA prices. So what maximum prices EUAs could reach in 2026? Why 2026? You will see it with Paul. We will have significant changes in the supply-demand balance of the EU ETS starting next year, which could lead to an increase in EUA prices. You will see it with Paul as well. So what maximum prices EUAs could reach next year? Will they stay below 90 euros per ton, between 90 and 100 euros per ton, or above 100 euros per ton? As a reminder, they traded EUA first deck prices for a small period above 100 euros per ton. So it's quite splitted between below 19 euros per ton and between 19 and 100 euros per ton. So most of you are thinking about prices remaining below their historical high next year. We don't know exactly what will happen after 26, but we'll see with Paul what are the drivers we expect in the coming months. So, Paul, the floor is yours.
Thank you, Julien. Yes, it's quite interesting to see that poll that not that many people see the price breaching 100 euros per ton. We'll see that. So on EUA, so yes, it's been quite a volatile beginning of the year. For years marked by cold weather first and very aggressive speculative activity in the beginning of the year, where one could have thought that market participants were already trying to price the tightening balance of 2026, but it was not the case, as EUAs sold off and remained very coupled to gas prices. Actually, in February and March, where we saw that milder weather and the gas dropped completely, and then we actually saw a switch in EUAs behavior, which began since April, as the tariffs hit the market with an unsurprisingly versatile US president. We saw US act very much as a risk asset, where we saw funds completely reduced their long positions on switch completely risk off in EUAs. And also in the recent weeks, also with the Middle East tensions. So unlike gas and oil, EUAs reacted quite negatively to geopolitical tensions. Again, acting as a risk-off reaction from market participants. So that are some changes in US behavior that we will analyze later. But first, more recently, at the beginning of the month, we had the European Commission that proposed changes to the EU climate law. First, we are affirming the 90% reduction target in 2040, but allowing some flexibility as we see some tensions rising between member states, between countries like Germany, Netherlands that have more climate ambitions, and the opposite, countries like Poland, Hungary that seek industrial competitiveness. And so that changes, for example, starting in 2036, member states could count carbon credits for non-EU climate projects for up to 3% of their reductions. There was a new CBAM proposal suggesting for heavy industry to use CBAM revenues to fund free allowances for EU exporters. So there is still no change, to be clear, there is still no change to the EU ETS targets, but if they happen, it would start affecting the balance after 2031. So I put on the right chart what would change in the targets and what it would mean in terms of supply reduction if the target would change. So as EU ETS has easier to abate sectors, we could see them achieve net zero to around 2040. But if the target were to be adjusted, there would be an impact on the linear reduction factor and thus on the cap that would impact the balance. So the too long negotiations will still take some more months before we have a more clear text, but this is clearly something to monitor over the long term. But now let's get back to more short-term supply and demand, and to better understand what is going on with US behavior, we need to focus first on power generation, which is still the most important sector. So you have here the gas-fired and the coal-fired power generation on both charts. And what we actually see is that compared with gas-fired power generation, we have the coal-fired power generation that remains clearly subdued all year because of high renewable capacity growth. We had solar power generation that reached all-time low, for example. Because also of the coal phase out that is happening in Europe, sorry. And because of that, in events such as the heat wave that we saw at the end of June, so it drives up the gas demand, but not the coal one. And in geopolitical tensions that should impact the gas supply, the rise in gas prices and thus clean gas costs didn't impact that much EUAs, to say so. So meaning there is little coal to gas switching right now. So what does it imply? It just implies that we saw a very strong drop in carbon and gas correlation, and that's why EUAs is decoupling from the energy complex in the past recent weeks. So as you can see on the chart on the right, the correlation between gas and carbon has dropped sharply and is near 2 yellow, which is quite impressive actually. But however, this decoupling in this part of the season, so in the summer, is not that an exceptional pattern. It has already been observed at the same time of the year in the years before. We saw that, as you can see, in 2024, in summer 2024, and in 2023, and in the years before actually, because of course, as we enter summer, and therefore we have lower power demand, there is less coal to gas switching, and the correlation tends to drop somewhat. So on the left chart, you can see here's a drop in correlation in summer. We also have a slight drop in May that could be attributed to the post-compliance deadline that was in April before, and we could see some decoupling between those assets. And but while the short-term correlation are still subdued, as you can see, so it suggests that the correlation often rebounds as quickly as they fall, as it drives arbitrage opportunities. But for now, because yes, power emissions are still the most important sector in the EU ETS, but with the growth of renewable capacity, the coal phase out, power emissions will drop the first, and importantly, which means less and less coal to gas switching, which means less and less correlation with gas. And with the year, power emissions will be less important, and the focus will switch towards more industrial and macro data. And speaking of that, if we now look into the details, so you have on the left chart the estimated power emissions on a monthly average, and on the right chart the estimated industrial emissions. So as you can see, in June, power emissions decreased to an all-time low due to, as already said, the highways penetration and the milder weather. Only the recent heat wave impacted very slightly and briefly emissions. And on the industrial side, while the EU economy is showing some sign of slow improvement, the multiple ECB rate cuts are starting to show their effects. Indeed, we have the industrial production growth that had been negative over the last 2 years, but we are now heading slowly toward a neutral territory. And the same with manufacturing PMIs that are gradually converging around the 50 mark. And we are seeing now that industrial emissions are actually in line with what is happening with last year. And for the first time on average, we have power emissions that are lower than industrial emissions this summer. So this is quite impressive. And if we look at the balance compared to 2024, so overall emissions are slightly up year on year, mainly because of what happened in January, February, where we had very cold weather, and that drove up that entailed more gas and coal-fired power generation, and thus power emissions were higher. But given the fact that power emissions should drop in summer, that should be below. So if we now look to speculators, the speculative position, they shifted quite aggressively to more risk averse, because the net speculative length now stands at around 50 million tons, with market participants that took less risks than in the beginning of the year. And as there were more macro and geopolitical risks, and EUAs trade more as a risk assets in the investment funds perspective. That's why they reduced a lot their net length, and it has got back EUAs to 75 euros per ton. So yes, there was plenty of volatility, but in the end, EUAs got back to that level. And as you can see on the right chart, so this is the cumulated open interest in the option market. So first at the March expiry, and then at the June expiry, most of the open interest was focused towards that 75 euros per ton level. On both those contracts expired exactly towards that level, and now, so which confirms that the option market is and remains a strong indicator of price direction. And now for the deck expiry, even though we are still far from it, we still see that level paying out. But if you look closely, we can see that there is some strong open interest for example, 100 euros per ton call position, indicating that some participants are already anticipating a sharp price increase. Because now, if we look long term, so for the rest of 2025, we expect sideways movement in EUA prices. But however, market participants and speculators could front run the tightening market of 2026. this is clearly something that we could see because it's almost programmed. Prices will increase and rise in 2026, but we could see that happen just before, as it's already known, market participant could buy before that deadline. And so it's been there for years, but now we are very close to 2026, and we expect a very short balance with several elements. So first, of course, the annual application of the linear reduction factor. Then the absence of the social climate fund allowances, the repower EU allowances that should come to an end in August 2026. And of course, last but not least, due to the high supply of the last years, the total number of allowances under circulation is higher than the threshold, and therefore the MSR will withhold volume starting from September of this year and in 2026. And furthermore, as 2025 is still a year with a high supply relative to its emissions, we expect that next year the TNEC will still be high enough so that the MSR will still withdraw volume also in 2027 and impact the supply, as you can see on the right chart. And we also have the maritime sector here that is coming and is being implemented that will drive higher emission for the next year in 2027. The aviation sector also that is growing, and industrial emissions that are still hard to abate that make us think that the price will sharply increase in 2026 and 2027. But however, we still think that the growth of renewable will have a severe impact on power emission in the end of the decade, and that's why we see a sharp increase in the next years, but slowing down the pace the year after. So that's it for me. Julien.
Thank you, Paul, for this presentation. So one question to start this Q&A session. So in gas part, Evaris mentioned that gas demand for power generation increased by 19% in the first half of the year. And at the same time, you also mentioned that emissions from the power sector were very low and at record low over the past few weeks and months. So how can we align these two assumptions? So is it linked to the sharp drop in coal generation?
Exactly. I think this was the main point of that, is that we are clearly seeing now the coal phase out taking place in Europe. So as you can see, the gas-fired power generation rise significantly, while the coal-fired power generation remains very low. And of course, this is also due to the high risk penetration that we are seeing this summer with the solar power generation that hit an all-time high, for example, in June. And thus, most of the heat wave, in fact, was covered by gas generators, and thus driving up less power emissions in the EU ETS. So yes, that's clearly because of the coal.
Okay. Second question. So you are quite bullish on the EUA prices for the next year. So should it not be supportive for gas and power prices as well?
Exactly. That's a very good question. In fact, I think now we are seeing some decoupling from gas due to less to coal to gas switching. What was happening in the last year is that gas was driving EUAs as it increases the clean gas cost, and thus you switch to coal. But in the next year, we could see carbon, in fact, influence gas as it will rise, but you still need to hedge that EUAs when you use gas. So it could, yes, impact gas, and of course it will also impact power in the next years, of course.
All right. Thank you, Paul.
Thank you.
Oh, I see. Oh, you have a last question. Sorry. So do you see potential for EUA prices to increase already this year in anticipation of the tightening and the anticipated price increase next year?
Yes, of course. What my view is that the anticipation of the tightening balance will come not from industrial perspective, but I think at least from investment funds that as we saw the change when EUAs change of phase in 2020 and 2021, we saw aggressive buying and open interest in the market, and I think we could see the same thing happening in the end of the year of 2025. Yes.
All right. So it's now time to switch to the European power outlook with Luc. Thank you, Paul, for your presentation and your answers. So the last poll of the session, of course, regarding a key topic for power market, the expected electricity demand growth. So do you expect growth in power demand in the coming year, so until the end of the decade? And if so, at which yearly compounding rates? So zero, no growth, and with power demand only driven by weather events. 0.5% growth, 1% growth, which is the current level, the European level, or above 1.5%, which means a significant uptick in power demand in the coming years. So let's have a look at the results. So well, 80% of the audience thinking about a growth rate between 1 and 1.5%, a bit above that. It's quite mixed as well. So I would say a minority of you thinking about no growth or very small growth. So overall, relatively optimistic outlook in terms of power demand. And we'll see with Luc that it's, of course, one of the key drivers of the power market for the coming months and years. So, Luc, the floor is yours.
Thanks, Julien. Hi, everyone. Pleasure to be here with you this morning. So we will start with demand, actually. Having a quick look back on what happened so far this year on the demand side. Keeping in mind the perspective that we are still far below pre-crisis levels in terms of power demand for EU 27. But we are recovering from the 23 low and slowly increasing. But a big part of that is due to weather, actually. So the year-on-year increase between 24 and 25 can be to some extent attributed to colder weather in January and February, and later in June and July to a heat wave that is really pushing power demand to the upside. We can still see that in low demand months, which are kind of usual in around April and May. We were actually this year below 2024 levels, which shows to some extent that there is still no structural increase in power demand, and so far it remains pretty subdued, and that has a big impact on the power balance in Western Europe, especially as France and Germany, the two biggest markets in continental Europe, are lagging behind in terms of this structural growth amid a wider, more uncertain macro environment. Now, to meet this slightly rising demand so far in the first half of 25, we need to look at how we supply the power market. So first thing is to look at the renewables. Solar on the upper left chart is setting new records throughout the year. In June, 13 countries in Europe set new records for solar generation, which is clearly huge, and is helping to put power prices under pressure. But they have their own set of challenges because sun only shines during the day. So in the evening, you still need gas or thermal assets to ramp up, or nuclear in the case of France. But yeah, that still helps and gives a significant share of renewable output in Europe. Wind was actually pretty bad, I may say. So for the previous winter in 24-25, and it only started to increase to normal levels around May, and was actually pretty strong in June, which had to also put pressure on prices. Hydro was really strong last year, thanks to really exceptional precipitations in Western Europe until the end of midsummer, let's say. It started to normalize at the end of the year. Water levels in reservoirs started to gradually decline throughout the winter, especially in a low wind environment, and they were normal so far this year and started to decline at the end of May, as the lower precipitations over the Alps especially put a lid on the hydro outputs. And last point is nuclear. It's been it's been setting the heartbeat of the European power market in Western Europe, and it's doing a strong comeback, and is often the marginal technology in the French power market. And there's really strong nuclear availability so far this spring and now summer, which really helps to put clean power on the grid. If we try to summarize all of that, to see the change of how so far this first half of 25 was supplied versus 24, well, basically we've had lower renewables overall, so less hydro, less wind, and the growth in solar was not sufficient to offset this decrease. So gas, as Évariste and Paul mentioned, increased mostly on the first quarter of 25, and that was needed to meet a slightly increasing demand so far for the first half of 25. Looking at the spot developments, you can clearly see so far this winter that we had pretty strong spiking events in January, followed by really low prices even during winter, the winter period. That really shows the spot volatility to wind events, especially. And you can see a gradual decline throughout February and March as temperatures gradually decrease, solar ramps up, and put the spot market under pressure throughout the whole Q2, with Spain and France really decoupling at the bottom of the chart here, while Germany and its close neighbors, Belgium and Netherlands, stay pretty elevated. The growth of solar can only do so much because you still need gas and or dispatchable power to ramp up in the evening, and sometimes at a pretty strong price because gas generators have to incur the startup cost to the spot market. So even if solar growth was really impressive, we had really strong irradiance levels in Western Europe. It cannot put so much pressure on the spot market. And obviously at the end of June, early July, a heat wave developing, tighter fundamentals with less hydro in Iberia, France, and some nuclear curtailment in France that I will cover in a second, that really put pressure on the demand side with strong increase in cooling demand, so AC in Spain, Italy, and France, that relate to close to recalls levels in terms of peak power demand for summer months. One of the big topic that is widely discussed on LinkedIn is the growing number of negative price hours. So here those include the prices at 0, but they really show that some periods or some hours during the day are strongly discounted on temporary oversupplies when you have too much solar on the grid and you need to export it. You are discounting this power below 0, trying to get rid of it, and this really shows the imbalance of demand and supply on some hours. And it's a growing share with above 8,000 hours a year. Maybe this year we'll get close to 10% of hours with negative or below 0 prices, so that would be around 800 hours. But we are almost reaching the last year's levels, which were already quite impressive. A part of that can be attributed to good irradiance this year, true, but there's still a growing supply side for solar. So here it's the case for Germany, with over 100 gigawatts of solar installed. But even if this growth is set to continue, we can still see some kind of decline as solar or like renewable developers are feeling a bit more uncertain in the current political environment, the uncertainty around support schemes that could end, or like change in regulation that could start to slow the growth of the renewable supply side. So that's what's shown here on the blue stack bars, the blue bars. That in 25 we installed less power, less solar capacity until May compared to 24, but the growth still remains strong so far. So the imbalance is set to continue as flexibility on the demand side and also on the utility scale is not sufficient so far to offset this growth. A last word on the spot. That was really a factor for over the past few days when you have too little hydro. That's been a trend for June, with decreasing runoff water levels in rivers, increasing temperatures because of elevated temperatures. Some assets can be curtailed. That's mainly the case in the south of France at Golfech or Bugey, where they need to meet regulatory requirements to protect the environment, and they need to modulate or ramp down or curtail altogether to protect the environment. So that can add even more pressure on the supply side during times where demand is already very high. A quick word on the spot outlook. So far this summer we could still expect this warm trend to continue throughout August. There's still a strong cooling risk for August and September in France due to low hydro levels. And further this fall and winter, we could expect wind to actually pick up and go back to normal levels. So that would help spot prices to ease compared to the previous winter, and also increase the spot volatility as wind events shape more deeply the spot market. A quick word on the forwards. So power markets are still tracking gas and carbon developments mainly. Germany and its close neighbors are a lot less discounted compared to France and Spain, given that they rely a lot more on gas to fall back as a fallback measure in case they don't have any renewables. And actually, the discount of German prices to the clean gas cost, so the black dotted line, has actually lowered throughout the year, as we see that solar is only doing that much, and its penetration is reaching the maximum almost effect on the spot prices. So there's a smaller discount on German prices compared to earlier this year. France had a really interesting spring with EDF selling heavy volumes on the Cal +1. Some nuclear oils started to push up the price again in June amid a tense geopolitical context, but were dismissed throughout the summer. The beginning of the summer, as no significant delay was announced by EDF, despite some stress corrosion found on one plant. And closing remarks on the forward. So to come back to the initial question, we are still expecting power demand to grow, and some sectors actually showing signs of improvements, especially EV sales, which are growing this year despite a wider market contraction. Heat pumps are stabilizing, but are still lagging behind in terms of the EU targets. Data centers could be a huge power driver, especially in France, where some new capacity was announced. That will add baseload power demand. In Germany, you had the new German coalition first announcing lower grid fees for all consumers, but now only for industrials. So that's not really so supportive for power demand in the end. And on the supply side, lots of uncertainty given the less friendly policy environment for developers, both on the new gas plants supply side and also on the storage side, with huge connection queues, even delaying some consumers connecting to the queue in the Netherlands very recently, for instance. So yeah, still a power market driven by fuels, which has limited downside given the flows on the gas side and the tightening market on the carbon side as well. Do we have any questions, Julien?
Yes, thank you, Luc. Stay with us. We are a bit late on schedule, so I will take the questions.
Cannot hear anyone.
Do you hear me? Do you hear me, Luc? Oh. I don't know if you hear me.
Okay, I'm sorry, maybe an issue on my end then. Seems like we've lost Julien indeed. Maybe you can take a question or two if there are any.
Hello, I'm back. Yeah, sorry for this technical issue. So yeah, I will just launch the quick satisfaction survey and take the questions on power at the same time. So we have questions for you, Luc, on the power side.
I see a battery question.
Yeah, we have questions, of course, regarding this amount of negative prices. And we know that there is a strong growth expected in battery installations, capacity installations in the coming years. So we need to reverse the trend in these negative power prices.
I'm not confident that it will, the pace at which solar and renewables are growing is greater than the required that what batteries will grow at. So that won't be sufficient, in my opinion. Wait, merci. Excusez-moi. And so so that won't be really sufficient on the to offset the trend expected on the negative prices.
All right, and we can also mention, for example, the case of the UK, where the amount of installed battery capacities is significant, and where we see much lower negative prices than the continent. So
yes,
it will be very interesting to track this evolution in the coming years. So one last question regarding the French market. Luc, if you are still with us. I think we have lost Luc. Yeah.
Yes, I'm here. Sorry.
What will happen in 26 after the end of the ARENH mechanism that still regulates the sale of French nuclear power in France?
So the ARENH mechanism will end at the end of the year, and the government will strike the deal with EDF, where they enforce some kind of cap on the nuclear sales. So it's mostly going to be OTC sales, so long-term deals with industrial consumers or heavy consumers in general. But that clearly won't be sufficient for all the 100 terawatt-hours that were in the ARENH mechanism. So some of that volume will go on the market, and that was, in my opinion, what we saw in over spring when we had heavy selling from EDF, and that also gives is an issue for transparency, in my opinion, because we don't know both any volumes or prices at which all the industrials get their power. So that adds another level of opacity.
All right. So I know we are late, but we do have new questions on the power market and interesting ones. So regarding this line on the baseload forward curve, regarding the French power market, we see that we are in contango from Cal 27 until the end of the decade. So why do we have this structure compared to other European countries?
It's due to the current oversupply normalizing in the coming years as new demand come in, and to have this sort of convergence of French and German prices toward the end of the decade. It's mostly it can be largely attributed to a growing demand outlook. As the French market is pretty attractive for heavy consumers, especially on data center side. So 1 gigawatt could be coming online as early as next year, and as I said, like on this slide, up to 4 gigawatts could come, and that's really supportive given that it's a baseload consumption profile.
All right. Thank you, Luc. Thank you all for your attention and your questions, and for taking the time to answer all the polls and the survey. So we will organize the next webinar session in September. So have a good summer break all, if you can take some days off. And it's now time to close the session. I hope you enjoyed it, and see you soon on EnergyScan. Goodbye.